Life insurance policies. One strategic approach to managing finances, often overlooked by the general public, is the utilization of life insurance policies. These policies serve not only as a means to provide for beneficiaries in the event of the policyholder's death, but also as a sophisticated financial tool. Specifically, certain types of life insurance, such as whole life or universal life, can accumulate cash value over time. This cash value grows on a tax-deferred basis and can be assessed through loans or withdrawals, offering a way to fund expenses or investments while potentially bypassing the immediate tax liabilities, typically associated with other forms of income or capital gains. This aspect of life insurance policies provides a nuanced avenue for financial planning, which, when used judiciously, can significantly impact long-term wealth accumulation and tax strategy. Capital gains tax. Capital gains tax is applied to the profits earned from the sale of assets such as stocks, bonds, or real estate. When these assets are sold for more than their original purchase price, the difference is considered a capital gain and is taxed accordingly. However, the rate at which these gains are taxed is frequently lower than the income tax rates applicable to regular earnings. This difference in tax rates can provide a significant advantage to those with the means to invest in such assets, potentially lowering their overall tax burden when compared to those whose primary source of income is wages or salaries. This system is intended to encourage investment and economic growth, but it may result in individuals with the resources to invest in the market paying a lower percentage of their total income in taxes than those who earn their income through labor. Real estate investments. Real estate investments provide numerous tax benefits that can significantly reduce the amount of owed to the government. For example, property owners can deduct their mortgage interest and property taxes from their taxable income, effectively reducing the amount of income subject to taxation. Furthermore, the costs of property maintenance and improvement can be deducted, lowering taxable income even more. These deductions are useful tools for investors because they allow them to reinvest savings in additional property purchases or improvements. Real estate also provides a distinct tax advantage through depreciation. This accounting method allows investors to spread the cost of a property over its useful life and deduct a portion of it each year. Despite the fact that the property's value may increase over time, the IRS allows this deduction, which can result in an investor reporting a paper loss for tax purposes while the actual value of their investment increases. This strategy is especially advantageous because it can offset income from other sources, lowering the overall tax burden in a legal and efficient manner. Charitable contributions. Charitable contributions are a significant aspect of tax planning that can benefit both the donor and the recipient. When individuals or corporations donate to a charity, they can often deduct the value of their contribution from their taxable income, effectively reducing the amount of tax they owe to the government. This provision is intended to encourage philanthropy, allowing taxpayers to support causes they believe in while also obtaining a financial benefit. By redirecting funds that would otherwise go towards taxes, donors can contribute to societal welfare, funding education, research, poverty alleviation, and more. However, it's important to understand that this system also allows for strategic tax planning, particularly among higher income earners. By making substantial charitable donations, the wealthy can significantly lower their taxable income. This method is entirely legal and can lead to large-scale contributions to nonprofits and charities. While this mechanism supports charitable organizations and funds important social causes, it also highlights the complex ways tax laws can be utilized to minimize tax liabilities. The effectiveness of charitable contributions as a tax reduction strategy underscores the need for awareness and understanding of tax laws to ensure that the spirit of philanthropy aligns with equitable tax contribution. Tax loss harvesting. Tax loss harvesting is a strategy employed in the realm of investment management, particularly advantageous for individuals with significant investment portfolios. At its core, this method involves selling off investments that have experienced a decrease in value, thus realizing a loss. These losses can then be used to offset any capital gains taxes due on profits from other investments. Essentially, by carefully selecting which investments to sell at a loss, investors can reduce their overall tax liability. This approach requires meticulous timing and a deep understanding of tax regulations to be executed effectively, making it a common tactic among those with the resources and knowledge to navigate the complexities of the tax system. Offshore tax havens. Offshore tax havens are countries or jurisdictions that impose extremely low or zero tax rates on foreign individuals and businesses, making them appealing destinations for wealthy individuals and corporations looking to reduce their tax burden. These havens frequently provide financial secrecy, allowing assets and earnings to remain hidden from tax authorities in the individual's or corporation's home country. While the use of offshore havens is legal when properly reported, it has raised ethical and fairness concerns because it can significantly reduce tax revenues that governments rely on to pay for public services. This strategy is typically beyond the reach of the average taxpayer, resulting in disproportionate tax burden on those who cannot afford sophisticated tax planning. Trusts. Trusts are financial arrangements that allow people to control how their assets are distributed, providing flexibility and potential tax benefits. A trust is formed when a person known as the settlor transfers assets to a trustee, who then holds and manages those assets on behalf of designated beneficiaries. This legal structure can be used to reduce estate taxes, protect assets from creditors, and ensure that wealth is passed down as the settlor wishes. By properly structuring a trust, assets can be distributed to beneficiaries without going through probate, potentially reducing the estate's exposure to taxes and legal challenges. This mechanism, while legal and widely used for a variety of legitimate planning purposes, can also be structured in sophisticated ways that, for some, significantly reduce the tax burden that would otherwise be incurred. Business structuring. Business entities such as corporations and limited liability companies, LLCs, can be used to manage and reduce tax liabilities through legal means. These entities are designed to separate personal and business finances while also providing a variety of tax planning strategies. For example, business owners can deduct legitimate business expenses before income is taxed and may qualify for lower tax rates on retained earnings within the company. Furthermore, some entities allow income to be passed through to owners, potentially resulting in favorable tax treatment. While these structures are available to all businesses, individuals with higher incomes frequently have more resources to effectively leverage such strategies, allowing them to optimize their tax situation within the legal limits. This approach to taxation emphasizes the importance of understanding tax laws and the potential benefits of various business structures.